Hello and welcome to this another in the series of A3 Management Consulting webinars. Today we're going to be talking about Texas and especially about ERCOT market prices. And Tom, if you could skip through the disclaimer slide onto the people there. That's me, Matt Brown. I'm Vice President in A3 Management Consulting, focused on the energy transition, and have been doing that for quite some time. And I'd ask my colleagues to just quickly introduce themselves as well.
Yeah, hi, this is Stuart Murray. I'm a senior principal with A3. I've been with the company since 2005. And then over the last 4 years, I've held responsibility for continuing the build out of A3's energy market consulting business across North America, headquarters in New York, although I am today actually coming to you from London, England. Tom, over to you.
Thank you, Stuart. Yes, Tom Williams. So I'm a senior consultant at A3. I've been with the company for coming up for 10 years now. Yeah, I've recently taken over as a market lead for ERCOT. Yeah, in that role, I principally manage client projects that we have going on in ERCOT, yeah, lead the development of our market modelling.
Lovely, thank you both. And if you go to the next slide, please, Tom. Then just to say, we are taking questions all the way through. We have a Q&A session at the end, and we've got also registration questions from people, so we'll deal with as many as we can, as usual. And we'll also get back to people individually with answers where we can't cover things in the webinar to the maximum extent that we are able. The slide pack and recording, as you can see there, is going to be available to everyone. Also, all of these webinars are put on the A3 Management Consulting website, and if you Google A3 energy webinars, you'll find all the back catalogue. There are over 20 there. We've been doing these since pretty much weekly since the start of March. So with that, I'll be back for moderating the Q&A. I will hand over and leave you in the capable hands of my colleague Stuart. Thank you.
Thanks very much, Matt. Yeah, so Tom, if you push on to the agenda. So yeah, good morning, good afternoon, everyone. Today we're going to be initially just running through a couple of key messages, and then that we'll be digging into in more detail. Before I move on to look at some of those recent summers and summer prices that we've seen in Texas recently. Afterwards, I'll hand over to Tom, and Tom will take us through expectations for both that short-term kind of front period, 2021 to 24, but also how we would see that weather volatility potentially persisting for the longer term. I'll bring it back to just talk about a few lessons to learn from other markets, other kind of weather-driven markets around the world, some case studies. As Matt says, he'll then pick it up for the Q&A. So next slide, please, Tom. So on those key messages, first of those is really a couple of major factors, rising renewable penetration, and a sharpening market signals from market design changes really have been behind some of that increase in weather-driven volatility that we've seen in ERCOT in recent summers. And rolling that forward over the next 3 to 5 years, we would see that weather assumptions really may be one of the biggest or the biggest uncertainty in price scenarios going forward. So taking a view on those is very important. Intriguingly and counterintuitively, our third message really is that potentially solar generators may be more exposed to some of that weather-driven price volatility than wind generators. And then finally, taking a look to the longer term, there are some parallels with other markets that we think can help provide some insights into what some of those future discussion points really may be for the ERCOT system. So Tom, if you can move that forward. So I'll take a look through to the next slide on those recent summers in Texas. So ERCOT is a summer peaking market. July and August traditionally those tightest months that we see, and that really traditionally comes from that demand peak. So cooling loans in ERCOT are very significant. And so we see that kind of high demand coming in the summer and leading to highest prices. It's interesting that doesn't mean that the peak power price is actually somewhat counter seasonal to the natural gas price peak, which would typically occur in winter, driven by gas demand elsewhere. So we can see here the average hourly prices from August 2018, August 2019, and August 2020. The dark blue lines you can see, that's the average power price in each hour, average in August across all nodes. You can see there, and then the lighter blue line shows the variation in that hourly price across the month of August. So we can clearly see there was a large change. August 2018 was obviously very low, and 19 being highest. And so 2018 was about $32 a megawatt hour on average, and the hourly peak was only $150 a megawatt hour. I will say that actually July was somewhat higher than August in 2018. So the peak prices were kind of more up towards that $2,000 mark. In 19 we saw kind of average around the clock prices up to 120, almost $130 a megawatt hour, peaking at 3,500. And worth noting, in 2019 we also saw the real time, these are day ahead prices, but the real time price actually reached the $9,000 cap. And then in 2020 we were back down to just under $40 a megawatt hour, without peaking at 2,000. So next slide looks a little bit into the other changes that we saw in the market in that August period. So we certainly saw an increase in capacity and contribution of renewables. We saw looking at that left-hand chart, which is the August nameplate capacity. There was a small step down in coal capacity in that time, but generally the big move there is that we see a kind of a larger contribution in terms of installed capacity from solar and wind. So wind increasing by almost 9 gigawatts and solar by 2.5 gigawatts, so 160% increase in solar over that period. Generally speaking, in terms of demand growth, we do see underlying structural demand growth in the ERCOT market. It's rising by around 2 to 4% a year, a lot more strongly than other North American markets. And actually, even in 2020, if we look at August as a whole, the 2020 demand in August was up slightly, not much, but that's despite COVID. So there is this underlying structural growth, somewhat driven by oil and gas investments, which I question mark over those, but also population growth. Other industrial growth is significant within Texas. The middle diagram looks at the peak load, and then the generation by fuel type that was meeting that peak load. Slightly different picture in that a 2% increase 2018 to 19, but then a slight fall in 2020. And we'll look at this a bit on the next slide, but that's really because the peak demand is very strongly driven by the strength and length of heat waves that we see in the Texas market. And August 2019 in particular was much hotter compared to the 10-year average, whereas actually 18 and 20 were a bit lower in terms of cooling degree days. So it's clear, final diagram on the right hand side, it's clear to see that the contribution of renewables, the capacity have been increasing, but also their contribution in that peak hour was also up significantly from 5.6 gigawatts to 12.1 in that absolute peak hour. But it's also clear it's not a uniform increase with capacity, and this kind of hints at something we'll come on to a bit later, which is that we can see that the peak hour capacity factor, which is shown in the green circles there for wind, was at only 23% in 2018, was actually 39% in 2019. So despite the fact we had a peaking price, you had a pretty good contribution of wind in that absolute peak hour. So we're already seeing, and they were all at 5 p.m. these peak hours in these years, but at 5 p.m. it's not guaranteed the wind generation in particular that you're getting at that time. although we also saw some variation in solar, and I think that's partly due to the rise of utility scale solar stepping up that capacity factor over time. Next slide, please, Tom. So, taking those key, those key underlying factors, so the variable prices and the rise in renewables, and then trying to unpick those a bit. What is it that we were really seeing that was influencing in prices, or those summer market prices over the period? And we really think that the flow goes from the market design in ERCOT, so it's an energy-only market design. But we've seen a number of changes that have really been directly targeted at making sure that at increasing, the value of scarcity and increasing the recognition of peaking capacity or firm capacity at peak times. And really the changes we've seen made in this, it's called the ORDC, so the operating reserve demand curve. So that that acts as a price adder in times of system stress when the reserves drop below 6,000 megawatts, and we've seen that kind of sharpened in 2019 and sharpened again in 2020, really recognizing the Public Utility Commission concern that the mechanism or the market design was undervaluing plants. So because of that historical undervaluing, we've seen a pretty tight system margin. And actually, although system margin gets talked a lot, between 18, 19 and 20, all of those summers we went into with a fairly significant lower than target system planning margin, 9.3% in 18, 8.6, then 10.6 in 2020, and that's all of those below the 13.75% target margin. So there, the market design led to those kind of that tight system, but at the same time, we saw that weather drive was very significant. So cooling degree days, we've discussed a bit already. So this is the West South Central Census region. You can see that cooling degree days, particularly in 2019, significantly above that 10-year average for August, although somewhat below in 18 and 20. And the second major weather driver really is that renewable capacity factor. And the previous chart showed that, or the previous slide talked about that in the peak hour, that's that 5 p.m. But actually what we see is that peak hour is it's not irrelevant for prices, but you need not just to think about the peak hour, you need to start thinking in terms of the tightest hour, and by that we really mean demand net renewable hour. And what we see happening there is that we can see this the capacity factor in tightest hour for solars is quite different and potentially lower than is it at the absolute peak hour, and the same for wind, and really that's because that renewables, the renewables on the system, they drive that tightest hour away from periods when they have high load factors. So that there's renewable output in those tightest periods is pretty variable as it moves around between years. So the market design has been evolving, and we see this in turn as making weather factors, which potentially have always been there, but those weather factors are becoming a more significant factor in the operation pricing of the market. So with that, I'll hand over to Tom to have a look at what we think that means for power price in future years.
Yeah, so thank you for that, Stuart. So yes, for this next section of the presentation, we'll be basically looking ahead into the future rather than backwards, and yeah, for the next few years. And one thing that is interesting to do as we look ahead to the next few years is to compare some of the market forward prices with our latest model projections for ERCOT, based on our latest update, which is the mid-2020 update. So just for reference, as we start this section, as part of our mid-2020 update, we developed two scenarios for ERCOT. So a central scenario representing our best view of the market, and a low scenario which represents a credible low power price case, and partly based on lower demand and commodity price assumptions. And for both of those scenarios, we model both using 5 different historical weather patterns to capture the interactions between the different weather-driven variables so demand and renewable output. So if we look at the forward contracts for peak prices, so monthly peak and off-peak price contracts can be traded in ERCOT a few years ahead, with peak hours in ERCOT being defined as 6 a.m. to 10 p.m. on weekdays. So yeah, if we look at the recent forward peak price forwards, they are shown on the chart here, and yeah, they're showing a consistent August peak. So the monthly contract for August is consistently the highest priced forward, and we also see that there's a slight fall over time over the next few years, with that forward contract for August becoming somewhat lower priced, although noting that there is a bit less liquidity further out, or a lot less liquidity further out on the curve. So yeah, perhaps take those with a pinch of salt. But anyway, that's what the current recent forwards certainly look like for peak prices in ERCOT. So if we now superimpose our the equivalent prices for ERCOT from our mid-2020 central scenario on a weather average basis, what we can see is that the weather average A3 central case is showing a trend of rising peak projections. So the shape is pretty similar, but we've got a rising peak, and we would say that a rising peak makes sense in terms of what we're projecting for ERCOT. So with rising demand and increasing renewable capacity, there's the economics would suggest that there's a greater need for capacity to be able to meet peaks in that system, and that's reflected in higher peak prices in our projections to enable peaking capacity to be incentivized to come in. So how credible is that? Well, there is a trend of rising peak prices in ERCOT, and that's partly driven by recent market design changes, such as the ORDC adder, which Stuart was referring to earlier. And as a result of those sorts of changes, the independent market monitor for ERCOT in their 2019 annual report pointed out that a best new entrant peaker in 2019 would have made enough money to be economic in 2019, which is the first time that's actually happened since 2011. So we would say that there is a trend for peak prices to rise, and for that to incentivize peakers. We're reflecting that here in our projections. However, there is a weather year range on our central projections. So as I mentioned, we model 5 different weather years for our scenarios. And if we superimpose the individual price tracks that we get based on those 5 different weather years, we get this quite interesting range. So what we can see here is that the tighter weather patterns of 2010 and 2011 are giving higher prices generally, and particularly at the peaks. And so by tighter patterns, we can loosely characterize that as having relatively high demand and relatively low renewable output. And then conversely, for the other 3 weather patterns, which are less tight, 2012, 2013, 2014, those are outturning at a lower level in prices. The thing that's interesting to observe, of course, here is that the forward prices look like they're coming in at about the level of the more benign weather patterns here, and there's a potential if we have weather like 2010, or we saw in 2010 and 2011, that much higher prices could be realised in the market. So with the caveat that the longer dated contracts particularly don't have a lot of liquidity, we would say that there's potentially a lack of pricing in of upside weather risk in the forward contracts. Okay, so we also model a low scenario. So what does it look like if we add our low scenario projections into this? Well, on a weather average basis, the forward peak prices are essentially falling between our central and low scenario peak price projections. So that's reasonably interesting. But then we can do something else, which is actually add some specific weather patterns of interest onto this. So firstly, I'm going to add the peak price projection based on the tightest weather pattern for the low scenario. So it's the low scenario based on 2011 weather. And if we look at that, we can see that that is above the weather projection, the weather average projection for the central scenario in the first couple of years. It's falling a little bit later on. But yeah, we're getting a price result from that, which is actually above the central weather average case. And then the other thing we can do is, I guess, the converse. So we're going to add the benign or less tight weather pattern of 2014 for the central scenario and superimpose that. So that's the blue dashed line now coming in. And what we can see there is that that's coming in, below the weather average low scenario, generally speaking. So this is quite interesting because what it's showing is that the patterns of wind and generation, solar irradiation and demands that are driven by the vagaries of the weather, in any given year in ERCOT at least, these have the potential to be a bigger driver of prices. Particularly, we're looking at peak prices here, but a bigger driver of those than the scenario that we're actually modelling. So noting that the low is actually intended to be a lower price scenario, lower volume demand, lower commodity prices. If we have a very tight weather pattern, we can go above the weather average central. So the weather here in ERCOT is potentially more important than the scenario we're in, which is quite interesting. Okay, so that was the next few years. What about beyond that and looking out further towards the longer term to 2050? So within our price scenarios for ERCOT, we meet increasing demand by building new capacity within our model, and we do that on the basis of the most economic new entrant capacity. So within our market scenarios, the viability of new entry is assessed from an investor standpoint. So if a new entrant is not able to meet its hurdle rate as assessed from the revenues that it earns in the model, then it will not be built. So in our central scenario, you can see the result of that for ERCOT as a whole on the left. Off the back of the continued demand growth across ERCOT, we have a projection of total capacity nearly doubling to 214 gigawatts by 2050. And you'll note that a lot of that growth is driven by solar PV and storage, although with no carbon price in Texas, new entrant CCGTs do actually continue to play a role into the 2040s. So in 2050, we've got 62 gigawatts of solar PV, which is accounting for nearly a third of the total installed capacity there in Texas. And then if we look at the chart on the right, which is just showing the capacity build out in ERCOT West, with its we're seeing that a lot of that is occurring in ERCOT West. So about half of the total solar PV growth for ERCOT as a whole is occurring in ERCOT West, and about a third of the storage as well. So with its abundant solar resources, ERCOT West is the most economically promising place to build solar and storage in Texas in our projections. So that's obviously an interesting build pattern, and as we'd expect with such a high penetration of solar and storage, we do see some significant price effects. So let's have a look at ERCOT West in a little bit more detail. So on this slide, firstly, I've got two charts. So firstly on the left, we've got the evolution of our central scenario baseload prices for ERCOT West. So these are indexed to 1, where 1 is the weather average price for 2021. And then we've got the weather range around our weather average dark blue line. And then on the right, I'm showing the evolution of our central scenario average within day price shape for ERCOT West. So that's also indexed to 1, where 1 is the average price for 2021. Okay, so you're effectively capturing with these index charts the evolution of the shape in both the baseload and the within day prices. So if we look firstly at the baseload charts, at the baseload level, the range in prices between the weather years is persisting over the long term. It is increasing a little bit towards 2030 when the need for new entry is tightening the system somewhat. And then it falls a little bit after that as the need for new entry lessens. If we look at the evolution of the within day price shape, that's where you can really see the impact of the solar coming in. So if we look at the firstly the line for 2021, we can see that there we're seeing the system as it is today with a peak at around 5 p.m. But then as more solar is deployed, the effect of that becomes quite noticeable even by 2030. With the daytime prices getting pushed down and the peak prices being pushed to later in the day, so towards more like about 9 p.m. When demand is still quite high, but the sun has obviously gone down. And obviously that reflects the fact that with more solar PV on the system does become suddenly significantly tighter as the sun comes down in the evening. In the late 2040s, the increasing penetration of batteries which charge during the day with benefiting from the low price solar power there. They are limiting the increase in prices, in peak prices. So you can see the 2050 peak's actually a little bit lower than that in 2040. And then overnight prices also showing some interesting evolution here. So at the moment, overnight prices are actually a little bit depressed. And that's mainly due to low demand and high wind generation, driving prices low. But as the system grows and wind becomes less significant in the system, that effect lessens, and you see a bit of an increase in prices overnight. So the conclusion from that is that even by 2030, we're looking at the system in ERCOT becoming quite solar driven. Even by 2030, and certainly by 2040 and 2050, it's a very weather-driven system as a result of all that solar capacity. And then finally, perhaps the slide that you're most interested in. The final slide I want to show is how capture rates for the different solar PV and onshore wind evolve over time. So for those of you who are not familiar with a capture rate, what we mean by a capture rate is it's the fraction of the average wholesale price that a generator is able to capture as a result of its generation pattern. So obviously if you're a baseload plant and you can run literally 100% of the time, then your capture price will reflect exactly the average baseload price. Obviously for intermittent generators like solar and wind, your output in each hour is varying, and therefore the price that you're capturing on average is going to be different from the price that you would capture if you were able to run all the time. And that's what we're showing here. The capture rate is that percentage relative to the base load price that you're able to capture. So we've got solar PV capture rates on the left out to 2050 and onshore wind on the right. And then, the weather average capture rate is shown in the solid colored line, yellow for solar and green for onshore wind. And then around that, we've got these error bars. And what they're showing is the variation due to the different weather years. So our 5 weather years, the highest capture rates coming from one of those and the lowest from the other, and that's setting the range on those error bars. So if we look firstly at the solar PV capture rate chart, first thing to note is that obviously the range at the moment is pretty big. So we've got revenues ranging from 90% base load up to 170%. So there's actually a huge range in the potential revenues that solar will capture in any given year, depending on the weather. So your weather risk can double or halve your revenues. And due to its stable generation patterns, solar actually, unlike wind, doesn't have a hedge against low or high price years. So in the case of wind, often it's the case that with high wind generation you have relatively low prices, but you're getting revenues based on a higher volume but a lower price. And conversely, when wind generation is lower, you often have higher prices, and there's a natural hedge for wind, which gives some revenue stability, but that's not the case for solar. So there's quite a wide variation in those capture rates at the moment. As time goes on, sticking with the solar PV charts, the capture rates are decreasing, and that's due to the increasing solar capacity coming onto the system, which is having the effect of depressing those prices within the day and pushing the scarcer periods into the evening. And by the time we get to 2050, in fact, the peak prices are now largely after dark. So effectively, solar isn't able to capture those high prices anymore. So the prices then are still differing by weather year, but as solar is not able to capture them, the range in weather year capture rates is shrinking to a much narrower range. If we look now just at wind on the right, so for wind, the capture rates are improving towards the mid 2030s, and that's actually benefiting from the effect of the solar coming in. Because the increased solar is pushing the high prices later in the day, that's actually when quite a lot of wind typically in ERCOT has higher generation, so it's able to capture that. And that gives that increase in capture rates for wind. And then we've got the range for wind is a bit more modest than it is for solar. There is a bit of an increase towards 2030, and that's mainly driven by the increasing range that comes from scarcity pricing, effectively because of the need for new entry on the system over that time. From 2030 to 2040, with the weather range narrowing, and that's due to actually wind coming in parts of Texas other than West Texas, which we're showing here. And then there's actually a very small increase after that, due to the increased role of batteries coming in, and increasing the prices overnight as well. Okay, so that was as much as I wanted to say on that. So quite a different pattern of capture prices, capture rates for solar and PV and onshore wind as we go out to 2050. And with that, I shall hand back to Stuart for the next section.
Thanks very much, Tom. In the interest of time, I'd like to leave definitely some at least 5+ minutes for the Q&A, and we want to get this done. Let everyone get on with their day when we get to 1:45. So I'll move through these next slides quite quickly. Obviously, if there's particular interest in them, always available by email afterwards. So really, this next section is about looking at a couple of case studies where the markets that already, let's say, have very weather-driven power prices, so potentially even more so than ERCOT, and really whether they give us any clues about where ERCOT might be going on its volatility curve, and whether what clues it might give us to the future of the ERCOT market, beyond those that Tom has talked about purely in terms of price. So firstly, first of those is the Nordic markets. Tom, if you can move forward. If you can't see the slide yet, there we go. Okay, so the Nordic power markets. So what to say about this is, it's a very hydro-driven market. It's obviously not one country. It's 4 countries in there, but it is around 55% hydropower, let's say, it has been hugely hydro dominated for the last 100 years. There is significant wind, and wind generation is probably now 10%, a bit more than 10%. So that's actually not dissimilar to the levels we probably see in ERCOT. But obviously a lot of the variation in prices that we see is about the variation in precipitation. It's about the variation in inflow over the year, then also between years. We've had real price spikes in the market. 2011 and 19, for example, were pretty high price years, but then a lot of kind of price troughs as well, particularly wet years, low prices. So as a hydro dominated system, we've got a team up in Oslo. We had a chat with them about what makes it work, this weather driven market, and a couple of the key parts they talked about were really about the value of storage and this long-term recognition of the value of storage as being key to the market. Enables the shifting of energy. They think in terms of hourly, daily, but also monthly shifting of energy around, and that's one of the things that's helped them to integrate ever more renewables into the system over time. The second of which is that the real value that they see in interconnecting. So that is both reinforcing the internal grid. It's not a full nodal market, but it is a multi-zone market in the Nordics. So they try and have the market structure, so they see the value in that reinforcement. But they've really been pushing in recent years to really strengthen the interconnection with the rest of Europe. And we see those prices in Europe now being quite influential on the prices in Nordic markets. But certainly the recognition that is a good way to deal with the peaks and troughs in weather, but how connecting to markets which have got different forms of themselves, weather driven generation, so hydro in the Nordics, but then onshore wind, offshore wind, solar in somewhere like Germany, that they are generally seen as kind of long-term complementary. Next slide, Tom. So then we get a next example. We're just going to have a quick look at this is the island, the all island market of Ireland and Northern Ireland. So on the left hand side it's the capacity there that we have in 2019, and we can see that you have in particular highlight that wind capacity is running at about 40%, so it's probably 1.5–2 times ERCOT in terms of the contribution of renewables we see. It is a relatively small market. It's about 7 gigawatt peak, I think. It's relatively small, but it is very isolated. It has 2 small connections with the GB market. Again, it's looking at strengthening those, looking at actually going around GB and going straight to France. But curtailment is a huge issue. And we look at that central chart, we can see in 2020 so far we've seen almost 10% curtailment in wind generation, and about 6% in solar, and really the expectation is that's going to keep increasing. So as they move to more renewables, put more wind and solar on the system, that we're probably 15%, and just explaining that's 15% at a market. That's essentially the hub level curtailment we're talking about. There is additional curtailment on top that they see from local network constraints, and certainly those constraints on the system mean that they're spending an awful lot of their time discussing technical grid modifications, etc., to try and increase the volume of renewables that they can get on the system. So I think it's certainly it come to the fore in the island of Ireland, that the need to make those changes. Next slide, Tom. So I think I've probably hit on these. So that those 4 messages that we see, really that valuing of storage, increasing that value of storage, and probably not just the 2 to 6 hour storage we see today, but likely to see a lot more thought being given to overnight storage or interweek, interseasonal, and that's concentrating solar power or hydrogen. Transmission reinforcement, I mean, transmission connections get a lot of airtime already. Obviously, in ERCOT, we talk a lot about reinforcing the grid. We've seen recent studies about more reinforcement across the US footprint. So will that come back to fore in ERCOT as we see more volatile prices, or if we see more volatile prices? Curtailments are here to stay, probably in a well-functioning market. So you need to be very, very aware of those. And then lastly, we expect market design to be continually under scrutiny. So that creates a risk, but also an opportunity if you can anticipate some of those market design changes. So with that, I'll hand back to Matt, and hopefully we've got about 5 minutes or so for the Q&A.
Excellent, thanks very much both. So we have quite a lot of questions, and not much time if we're up to the 45 minutes, although those that can could stay a little longer and we can answer more. So I'll just go straight off with the first one. Are there non-market new technology or renewable subsidies distorting the market? I think, Tom, maybe you could take that one.
Sure, yeah, thanks, Matt. So yeah, ERCOT has had the tax credit subsidies, the PTC and the for wind, and the ITC for solar, and actually those have been quite major drivers of the renewable deployment that's happened in ERCOT. So those are phasing down. Solar will continue for the ITC for solar will continue at a low level. But yeah, the wind is PTC is phasing down for new projects over the next few years. So yeah, certainly there has been subsidy there in ERCOT for renewables, and that arguably has distorted things, perhaps arguably in a good way. But yeah, that's certainly been true. I think going forward, there aren't other subsidies. ERCOT doesn't have a carbon price, for example, and yeah, certainly the general philosophical approach of ERCOT and its market design, is that they claim that they want to try and make it an energy-only market and avoid other forms of subsidy, capacity markets. There's no plan to introduce a carbon price. There's no plan to introduce some of the other types of renewable subsidy that are common in other US states. So yeah, it's not true to say that it's completely not distorted by subsidies, but it's certainly quite a pure market in terms of not having many subsidies.
Lovely, thank you very much. Next question: will growth in PV installed capacity mitigate price volatility going forward? Stu, one for you.
Yeah, and I think I link that back to thanks for that, Matt. Well, I think in some ways Tom's already said some of this going, but I think it's interesting that we'll see. If you're looking for a match of solar, it is going to have a good match to when peak occurs. So you can see the depressing of prices. But I will say that doesn't, if we look historically back at the weather variability, I'm not sure it would necessarily have helped, because it's being driven by hot summers, at least in part by hot summers and not so hot summers, and you're not going to get just because it's 10 degrees Fahrenheit hotter, a rule of thumb in ERCOT, if it's 1 degree Fahrenheit increases 0.5 to 1 gigawatt increase in demand. So just because it's 10 degrees Fahrenheit hotter doesn't mean you get 20% more PV output in that period. So although it will kind of tend to decrease some of those prices in that midday, it's not actually going to necessarily decrease that volatility. But then certainly as you move into the nighttime period, obviously solar is not generating. So while we see a decrease in peak, and your peak product probably decreases down towards the off-peak product over time, it probably doesn't follow that necessarily means that you don't see weather volatility going forward.
Very good, thank you. Next one, there's sort of two questions that are quite similar or could be rolled into one here. So the first is the power storage impact going to be discussed in the webinar? Is your software able to integrate, deal with it, power storage that is? Opportunity for storage given increasing volatility. How sustainable is the volatility from weather and storage levels increase? Tom.
Yeah, thanks, Matt, and thanks for the question. So yeah, we have a market model called Bid 3, and actually that had its origins in two separate market models. So there was Zephyr, which was developed mainly to deal with intermittency and renewable output and so on being intermittent. And then Bid was the Nordic hydro model, and that deals with the storage questions around hydro and optimizing the value of water in storage. So by bringing those two together, we've now got Bid 3, which can actually do both. And obviously, as part of that, the storage element is built into the architecture of the model. Yeah, and within our sort of daily use of Bid 3 in different projects, we're able to model storage at lots of different levels. Yeah, that includes obviously the sort of hot topics of the moment, so 1 hour and 2 hour and 4 hour batteries, and you can also include flexible demand from EVs, flexible heat pumps, demand side response, and potentially other storage on longer time frames as well. So you can do electrolysis with hydrogen and so on. So it's certainly we've got the scope to model all those different types of storage, all those different timeframes within our model. On the second part of the question, opportunity for storage given increasing volatility. Well, there's certainly, yes. I think you would see from our discussion today that there's certainly an opportunity for storage in ERCOT, particularly given the advent of all this solar capacity coming in, and that will mitigate some of the within day particularly volatility, and it will mitigate also a little bit the potentially the peak prices that occur, but yeah, it's certainly the mainly battery 4 hour sort of battery storage that we've got there isn't going to remove weather volatility completely. There'll still be significant weather volatility. Yeah, so if you look back at the earlier slide with that within day shape, the peak price in 2050 is still quite significant. So yeah, certainly an opportunity, but yeah, obviously if storage did remove all volatility, it wouldn't be economic. So that's the other reason that some will remain.
And suffice to say, in the modelling in general, the investments that get made, we check that they are economic at a predetermined rate of return, and so the model will build storage up to the point that storage makes sense, and leave the not completely get rid of all of that sort of within day volatility that you would see. Next question: expected impact of the subject volatility on demand. Expected impact of the subject volatility on demand pricing and term of future corporate PPAs and bank hedges in ERCOT. Stu.
Yeah, thanks, Matt. I've seen this one come in, and there's one or two others around hedges and what's being used in the market and how common. I always say it's a subject for a webinar in its own right. It's a complex subject, there's a lot going on. ERCOT likes to lead the way in terms of complex hedges. Some things to say on it, I think, is that we've I do think that showing impact on some of those hedges, maybe less on what might be coming in the future, but maybe on some of what's out there right now is something we see a lot of, is these fixed shape hedges. So that's where you're kind of guaranteeing it's not just they're not just taking all the power you produce, but you're producing power to an agreed shape. Now, you can estimate your wind output reasonably well, but if you're estimating it years ahead of time, you don't know exactly what you're going to be producing at 4 or 5 p.m. as we've seen the variability in the modelling. And I think that creates significant risk that, you know, when you're not generating at 4 or 5 p.m., you know, lots of the other wind generators aren't either. The prices spike to thousands of dollars a megawatt hour, and then you're kind of forced to go and buy back from the market to meet your fixed hedge. So yes, your revenue is kind of fixed, but what people maybe haven't paid enough attention to is the cost line of the buyback line, and we don't really see that balances out. So I think there are, you know, it's going forward, we see there's options out there, you know, these balance of hedge type products, which are interesting if they can work and kind of help to mitigate some of that risk. But I think, yeah, in general terms, definitely some concern from our side that some of those hedges, etc., that are out there, perhaps not providing as much protection to owners, investors as they expect. Yeah, when they run their numbers through a more simplified price shape model, they look great, but in reality, you know, prices are going to have that additional volatility.
Very good. One last one here, which is a sort of adjacent question, building off the theme of an energy-only market, which it sounds like Texas isn't really anymore. What will be the implications for a developing country to adopt a pure energy-only market? Stu, do you want to take that? I can jump in as well if you like.
Yeah, so well, you know, I think people in ERCOT or the might get upset that it's not an energy only market. It doesn't have a capacity market, definitely, but I think they have shown through their, you know, this ORDC and other features, you know, talk about co-optimize, a lot of discussion about co-optimizing reserve and response into the schedule. So there are still market design issues which can push prices around even in a you know, an energy only market. So I think it's worth noting that just it's not necessarily just a do the market design and forget about it. Even under an energy only market, that although I would say I have some sympathy for the position of ERCOT that you know, a capacity market is just too open to fiddling, given a lot of the other places we see capacity markets in the US. So
fiddling is, I'm not sure fiddling is a defined term.
Okay, well, anyway, you know, the constant push and pull, and then the you know, overlapping regulatory or regulators pushing things around makes it very hard for investors. Anyway, so for a developing country, so I think that, you know, if you look at the spectrum of market designs, even across North America, but obviously pure energy only market is you know, is pretty far across in terms of, you know, relying on pure market signals to give people that in particular give people the decision to invest, and therefore you do run the risk, as we've seen in ERCOT, of having much lower capacity margins than you would like. So potentially it saves consumers money, but it does lead to very low potentially low capacity margins in some periods. And actually, a purist would say that you know, it is correct in energy only market that you get, you know, periods of lost load and periods when prices get very, very high, which is what you need to kind of incentivize that scarcity to bring new entry. So certainly, I think it would be got a brave decision for that to be the first energy market entered into in developing countries.
Although if you took the view that depending on the country, a developing country was used to having a certain amount of lost load and couldn't afford to pay for a capacity market or capacity mechanism, it may make sense. It's perhaps more politically acceptable, which is always the problem, isn't it? Is you know, we could understand what the market design, the best market design would be, but is it politically acceptable? Is it going to be acceptable to the population? And when there are big headlines saying that industry had to turn down for a few hours, even if there isn't actually much economic loss, but it still makes a lot of news, it's always a problem. And I think the other thing about everything is specific to the situation, I would say. So, you know, it depends on the size of the system as well. And we talked, you know, Stuart talked about the Irish market. The Irish market was struggling for a long time because when being a small market, when someone built a large power station, it would mean that there was oversupply for a long period of time, and there was a lack of investment, and they ended up in Ireland for a period of time actually renting in peakers before they then put a new market design in, which included a capacity mechanism, because they were very cognizant of the fact that with the size of the market, it was difficult to maintain the investment that basically was wanted to be seen. So so it also depends, I think, with all electricity markets, it's so important that there's not a one size fits all. Everything has to be tailored to the resources you have, the geography, the interconnection, everything is so important. So that's why when we do market design, we start really from the first principles and from the local situation, rather than coming and saying, this is, our solution is to have, for instance, a nodal, centralized option. We would look at the specifics and judge the option in market design by what is needed in that location. Any other thoughts, Stuart or Tom, on that one? If not, then I will say thank you very much to our presenters today, and thank you all to joining us in this webinar. If you click onto the next slide, I think we would just probably skip those key messages and say that the next webinar is the Colombian electricity market on Thursday, the 1st of October. You've got Stuart and Tom's contacts there as well if you want to get in touch directly. Colombian electricity market is very interesting at the moment, so please join us for that. And then there is another webinar on a week later on the 8th of October, and that will be available for registration soon as well. So please join us again. Thank you very much, everyone, and see you next time. Bye-bye.